Hey everyone, welcome back to The Explainer. Today, we're taking what usually looks like a super dense, intimidating chapter from a financial accounting textbook, and, well, we're going to flip it into a logical, easy-to-follow journey. We're talking about the complete life cycle of corporate debt, specifically the issue and redemption of debentures. We're not just going to memorize dry journal entries here. We're actually going to understand the real story behind the numbers. Let's get right into it. Okay, let's dive into this. Here's our roadmap for today. 1. What are debentures? 2. Shares versus debentures. 3. Types of debentures. 4. Issuing corporate debt. And finally, number 5, redeeming the debentures. See? A complex topic broken down into a nice, clear, finite structure. Section 1. What are debentures? The foundation of long-term corporate borrowing. So think about this fundamental problem for a second. Say a company wants to expand, right? Maybe they want to build a massive new manufacturing plant, or maybe they're eyeing a competitor for an acquisition. Naturally, they raise capital by issuing shares. But realistically, the funds they get from issuing shares are seldom actually enough to meet those massive long-term financial needs. It's just not enough juice. They need another major source of capital. So where do they turn when they still need a ton of cash? They turn to long-term borrowing. And boom, that brings us to the solution, the debenture. Let's break down the jargon a bit. The word itself actually comes from the Latin root debere, which literally just means to borrow. Basically, a debenture is a written instrument that acknowledges a debt and it's officially stamped right under the common seal of the company. Now, per Section 230 of the Companies Act 2013, this definition is pretty broad. It includes bonds and other securities too. But here's the absolute crucial part you need to remember. It contains a firm, ironclad contract for the repayment of the principal amount after a specified period, along with a promise to pay interest at a fixed rate. Moving on to Section 2, shares versus debentures, understanding the distinct differences. And this brilliantly illustrates exactly what we're talking about. Look at the core contrasts here. A share represents ownership. It's part of the owned capital. But a debenture, that represents debt. It is purely borrowed capital. Now, the return on a share is a dividend, right? Which is an appropriation of profit. But the return on a debenture is interest. And guys, this is a massive distinction. Interest on debentures is a charge on profits, which means it absolutely must be paid even if the company makes literally zero profit. No way around it. Finally, shareholders get voting rights to steer the company, whereas debenture holders, they generally get no voting rights at all. They are lenders, plain and simple, not owners. Section 3. Types of debentures. The diverse flavors of corporate debt. Companies actually have incredible flexibility here. They can tailor these financial instruments based on several broad categories: security, tenure, mode of redemption, the coupon rate, which is just a fancy term for the interest rate, and registration. Now, what's really interesting about this matrix is the sheer variety of debt a company can issue. It's like a giant puzzle. Take security, for example. A secured debenture carries a charge over the company's assets. That means if the company completely defaults, the lenders have a claim on specific assets. That's a fixed charge. Or general assets, a floating charge. Then, under registration, you've got bearer debentures, which are treated almost like cash, where whoever physically holds the paper gets the money. Compare that to registered debentures, where the company keeps a strict official log of the owner. You even have zero coupon rate debentures. These don't pay regular interest at all, but instead they're sold at a deep, deep discount up front. It's a highly customizable tool for sure. All right, Section 4, issuing corporate debt, the mechanics and accounting of borrowing. So, just like products in a store, debentures don't always sell for their exact face value. They can be issued at par, which is face value, at a premium, so above face value, or at a discount, below face value. For example, a 100 rupee debenture might actually be issued at 95 rupees. That 5 rupee discount, that's a loss on issue. Now, the source material highlights a really important accounting rule here. This discount must be carefully written off. If it's going to be written off within 12 months or within the period of the operating cycle, it sits under other current assets. But if it stretches beyond 12 months, it goes under other non-current assets. Precision really matters here. Now, instead of just reading you a bunch of dry journal entries, let's visualize the actual chronological flow of the money in motion. When an issue opens, the public sends their money to the company first. And that is exactly why step 1 is always debiting the bank account. The cash has physically arrived. This gets recorded as debenture application money. Then, moving to step 2, the company's board officially accepts the loan and allots the debentures. This transfers that application money into the actual debenture liability account. It perfectly tracks reality, step by step. So the crucial point here is how this tells a story on an actual balance sheet. If you look under the main heading of equity and liabilities, we have non-current liabilities. Right underneath that sits long-term borrowings. And if you check the notes to accounts, we specify exactly what the whole shebang is. 2,000 10% debentures of 100 rupees each. This basically anchors all the abstract math and journal entries we were just talking about right into a concrete, transparent financial report. And that brings us to Section 5, Redeeming the Debentures, Extinguishing the Liability. Let's define our terms clearly one last time. Redemption is simply the extinguishing or discharging of the liability. What does that mean in plain English? Well, it just means the repayment of the amount of the debentures by the company back to the debenture holders. And this has to be done strictly according to the terms they agreed upon when they first issued them. Let's move on and see how this builds a whole matrix of accounting possibilities. Because you can issue debt at different prices and you can promise to repay it at different prices, accountants actually have to manage 6 distinct scenarios. For instance, a company might issue a debenture at a discount today just to attract buyers, but promise to redeem it at full par value later. Or, they might issue it at par today, but sweeten the deal by promising to redeem it at a premium in the future. The specific accounting entries you make are entirely dictated by these unique combinations, how the debt was priced on day one and how it must eventually be paid back. As we wrap up this explainer, I want to leave you with a really fascinating question from the source materials self-study section. Can a company purchase its own debentures in the open market? The answer is a resounding yes. They're literally called own debentures. A company might buy them straight from the market to cancel them out, or, get this, even keep them as investments. It kind of makes you think differently about corporate debt, doesn't it? It's not just a static liability sitting on a ledger. It's a dynamic instrument that companies use for real strategic market moves. Keep that intriguing thought in mind as you continue your focused learning journey. Thanks for joining us today, and until next time.